Welcome to another LinkedIn Live here. My co host, Matt, his wife just gave birth, so he is at the hospital. He won't be able to join us, but he did send a pic of his beautiful new baby, so that's awesome. I've got George over in the background. He's working out some technical difficulties on the sound, so I'll bring him in once he's got that all sorted out. And yeah, so I'll introduce him. Today we've got a remarkable guest. He's rewriting the playbook on how data science and real estate intersect. And so join me in welcoming George Roberts, an entrepreneur, data scientist, and a multifamily real estate maverick. Get ready to dive into a world where innovation meets investment. So I don't know, George, you got some audio over there? Let's see. I'll bring him in. Hey, George.
Hey, how's this?
Yeah, we're good.
All right, we're
Awesome.
live.
We're live. So I'm really excited to have you on here. I also have a background in data science. I went to RIT and, okay, he's back. I went to RIT. I studied color science for my master's degree, and that was all computational. My favorite class was matrix algebra. So I'm really excited to learn more about what you're doing. But if you want to start maybe at the beginning of how you got into real estate and transition to that, I think that's usually pretty helpful for the audience.
Yeah, absolutely. And I remember matrix algebra. That was a lot of fun. I enjoyed that. And I don't know, maybe that's an odd class to love, but
Mm-hmm.
definitely a lot of life applications there. So I did start out in bioscience. I worked in three fields, actually: physiology, microbiology, and genomics. Had a great time, loved it, but wanted to get out into the business world, feeling that I would get a lot more freedom. So then I became an award-winning data scientist, worked in fintech, and it was a perfect fit. Love investing, and didn't realize at the time that that was going to become the main event in my life. So from there, really had to just reinvent myself. And as an investor, everybody's got to have an angle. So I decided that I'd go back and take that data angle
Mm-hmm.
and help people understand. I want to do it in an entertaining way because I think there's a lot of people who geek out on the data, and that's great. But I want to reach a wider audience. And the only way that you get to do that, you really have to make it fun. So that's what I do.
That's so cool. What's your favorite way to geek out on the data? Like, what are you
Uh,
doing?
well, just start with places to go. Fred. Fred's a
Mm-hmm.
place I can spend a lot of time on. Go out to Fred and just see some amazing things there. And I think that's probably the best single place that you can get real estate and other macroeconomic data.
Mm-hmm. But we know that real estate is very hyper localized. So, I like Fred as well, but sometimes those trends might not necessarily be what you're seeing in a micro market, of a different metro or something like that. How do you find you're doing when you're diving down into a more specific area, but you're looking at macro data?
So one of the things that I think is most valuable is city data. Now it's getting a little bit out of date these days, but the idea is the same. It takes a long time for these metros to really change in a big way. And so if you go to city data, I mean you can get right down to the census block.
Mm-hmm. Very cool. And then, are you pulling that data into some other system that you're using? We were big with MATLAB programming, which is,
Oh
mathematical
yeah.
programming. Like, are you taking that data into something like MATLAB and then doing stuff with it and making your own custom algorithms, or are you kind of using it as just like guidelines for your investment thesis?
Well, both. I mean, look, you can go as deep as you want. So
Hmm.
so much you can do with Excel. I know that's kind of maligned in our field, but
Hmm.
when you just got to get it out and you got to share it, it's a good way to go. Python is great. I mean, still, I mean, I was an old R guy from way back when that was like a biotech sort of thing, and it was cool to be able to use that a little bit later in my career. But again, that's looks like ours is kind of being left behind. So yeah, without a doubt, doing some further analysis and getting deep is really important.
That's cool. Maybe talk a little bit about how you're getting deep. What data sources you find are the best as far as bringing those in, and then what are you doing to those data sets to get extra value out?
Right. Well, I think that one of the most obvious things you need to do when you're getting deeper with data here, let's just pick one. Like, for example, housing. I think
Hmm.
this is something that the people are not really fully understanding, and I'm going to have a great big YouTube on this soon. But I think the biggest thing is that just understand, like, why are things changing? Right? We've got these longer and longer cycles, and I mean, if I could put it up, I think it would make a lot more sense. But ever since the Volcker era, we've had these longer and longer cycles. The first one through the 1980s was caused by those super high interest rates.
Hmm.
And that really put the kibosh on home building. But since then, we've had zero interest rates. We have the opposite issue.
Hmm.
And we just built ourselves up to the point that we basically prices had only one place to go,
Yeah.
and set us up for now the third housing, or I should say, construction cycle since Volcker's tenure at the Fed. So just understand, I mean, these cycles, they're getting longer, and understand why they're getting longer. And then again, like you're saying, you really got to get down to the local level. So on the nationwide level, obviously we're hugely underbuilt. But then you've got to go and you've got to look at things like, what are the completions expected over the next year or two, and you've got to get really deep in terms of absorption. First of all, what have you seen the last 12 months and what's projected, to get an idea of really where your market is headed.
Hmm. Wow. And what markets are you focusing on?
So I like Midwest markets, and I
Hmm.
like maybe the upper South. I think a lot of things, everybody was in the Southeast, the Sun Belt. It just became so trite to say, yeah, we're looking for multifamily in the Sun Belt. Everybody is. And
Yeah.
I think there's still some good markets. I still like parts of Florida. Florida, people are still going there, right? And
Hmm.
as long as they are, then it still makes sense. But I think, particularly if you're a newer investor, you want to get someplace where you're in earlier innings.
Hmm.
And I think the Midwest might be the place to do that. For
Yeah.
example, East Tennessee, I think, is a great place. It's beautiful. People are moving out there now that you've got all this geographical freedom. You can work from home. And why wouldn't you want to work from the Smoky Mountains? And
Right.
it's not built up like Central Tennessee. So why wouldn't you go out there, live a little more cheaply, and have all that natural beauty? It's where people are flocking. So and there's also a lot of affordability, which I
Hmm.
kind of brings me back to the Midwest. I think the most important thing to do is you really got to look at many, many layers. So a lot of people look at migration. A lot of people look at things like earnings potential and where the home values are going. But you really just got to layer it all together. Where are people moving? Where is it affordable? Because you have all these rent constrained metros, and if you invest there, I don't really know where you expect your returns to come from. If you think everybody's going to get a raise, that's great, and eventually it'll happen. But what's going to happen over the next 1, 2, 3, 4 years that you're in the project might be a little less exciting than it could be. So I'm really looking at places like Cincinnati. I think Cincinnati is great. It's on the rebound. It's on a lot of people's radar. I know Indianapolis is a place that people have been looking for a long time, but really looking for those places that people may not have been thinking as much about. Dayton's on the rebound too. I know everybody wants to go buy in Columbus, right?
Hmm.
Columbus is just a huge market in Ohio, but there are other places as well. And I think you really would do well to look a little bit off the beaten path.
Yeah. How much does politics play into this as far as like, blue states versus red states and blue metros? How do you see that? Do
Well, I
you
guess
stay
now that
away
we're
from blue?
addressing the elephant in the room, we'll
Yeah.
just go straight for it. I think it's really a long-term thing.
Hmm.
Yeah, sure. I mean, I don't know if I'd really quite divide it up blue states, red states, but pretty much that's how it ends up going, right? You've got certain states. I live in Michigan, it's a blue state. We're talking about rent control from time to time. And
Hmm.
so we don't have it, but it could come. And you need to know that. So You really got to study up, and then you also have to look at things a little more closely. Like for example, Kentucky. Most people call that a red state and say that that's landlord friendly. But if you look at what happened during COVID, it was anything but friendly. So without a doubt, being landlord friendly is a huge thing to me. But at the same time, really got to drill down a little bit because there's definitely shades.
Mhm. Yeah, I've been operating in a blue state my whole career, so I'm just kind of used to it. So I think I could probably go anywhere and
Mhm,
be happy. Coming from a very tenant friendly, and it's gotten worse and worse and worse over the years since I started.
mhm,
When I started my career, you could have an eviction processed in 3 months, and you'd be upset if it took 4 months. Fast
mhm.
forward to today, and we could be
Yeah,
looking at a year to get somebody out of the unit. It's insanity. So I've got investors that have come over the years from other states that have invested in Rochester, and they're starting to say, "Hey, why am I here? Can you remind me again? Is Should I be here anymore, or should I just get out of Dodge
right.
and kind of lick my wounds and go find another place to invest?" And I think that's the sentiment, as far as I can tell from the people that I manage for. They're really, they haven't pulled the plug completely, but I can tell that they're definitely thinking about it.
Well, I think you're absolutely right. You're going to find good deals everywhere. So that's why I would say that, I see it in terms of shades, and I wouldn't necessarily give up on a state if it's priced in. But the question is, are things getting better or worse? And that's
Mhm.
hard to say. Things can always get worse.
Yeah. Yeah. And then, as far as like taxes, you're tracking that data as well to see, and budgets and all that stuff. So I'd be curious of what you think about that, and what do you think about initiatives like bids? Our city has got a bid that's in right now for the downtown core. We've got a lot of locals that are opposing it, and then obviously we've got developers and investors that
Right.
are for it because they want to really spark that area and have it be able to gain some traction.
Right. Well, tax is something you definitely have to take a very close look at. There's a lot of things you can do. If you have bigger deals, you can actually get a tax consultant to come in and tell you where your taxes are going to come in. Just to expand it a little bit to underwriting, insurance is also huge. Definitely need to bid that out. I mean, that's something I know experienced investors, they know this, they do this. But some of the younger investors, I think if you're newer, not so long in the tooth, a lot of people are just getting out there and they're, I hate to say it, trusting the pro forma. I mean, go
Mhm.
engage your insurance expert as soon as possible. You got to figure out what those major expenses are going to be.
Yeah. So you're saying they're taking a pro forma that maybe they pulled off the internet for free,
Oh
and they're
yeah,
saying, this is what I can expect for insurance. This is what I can expect for these things, and they're not really even checking quotes.
absolutely, absolutely. And I'm sure there's a lot of beginners out there. I'm sure your audience is very experienced, but there's always beginners out there. Definitely engage as soon as possible, and ideally, before you even put it under contract, because boom, you don't want to be in a retrade situation. So if
Hmm.
you can do it before the LOI, even better. The
Yeah.
sharper you can get those numbers. And I think that unfortunately it's just something I see a lot of.
Hmm. Now, are you in the build to rent space? Are you repositioning, existing stock and doing value add, or what's your
Yeah, I'm
strategy?
repositioning existing stock, but I'll tell you, I think that build to rent is exciting. We need more units, and we need to find ways that builders can build in a cost-effective fashion.
Yeah.
And it's just common sense. I mean, right now, I want to say we're at least 5.7 million homes before, I'm sorry, behind where we should be right now. And with that kind of a backlog, is it any wonder that builders are simply picking the best projects?
Hmm.
And now, with funding becoming more scarce, it just gets harder every day.
Yeah.
And we don't know when a recession is coming. All I know is that we're one day closer to it today, Mark, than we were
Yeah.
yesterday.
Yes.
So it will come. And when that happens, I mean, you can just watch the housing starts fall off a cliff. So to
Hmm.
consider that we've only had 4 months since the middle of 2007 that we have been on track to complete more than 1.5 million units in a year. I mean, this is going to be the first time that during the boom times that we don't overbuild.
Yeah.
So we can expect that 5.7 million backlog might become six. It might become seven or eight before we
Yeah.
start to chew through it. So This is really uncharted territory.
Yeah. So digging into that a little bit deeper, how are we going to have a severe pullback in prices if we are so undersupplied?
Yeah, and I think that's exactly what's supporting us this time. And there are a lot of other things supporting us too. I mean, we have a lot more equity this time around,
Mhm.
and so there's a lot less risk on that borrower side, but the product side also. It never made sense to get an ARM ever
Mhm.
since the Great Recession. So you can say, well, hey, people got stung a little bit, but how long does that last? A year or two,
Right. Yeah.
maybe three? But it just never made sense. So we don't have the arms in the mix like the last time. The subprime. I mean, I'll give you two sides of the story. So now we have our qualified mortgages thanks to Dodd-Frank. So on the one hand, maybe there's some chicanery that was drummed out of the system, but at the same time, it's really hard to get a mortgage for a cheaper home.
Mhm.
Probably one of the other things that's influencing builders to stay away from the cheaper stuff. So it's it's a very different situation this time around.
Yeah. Yeah. Cause it's like 60% of homeowners have a mortgage that's under 4%, right? And like 40% of homeowners are in cash. Not, those aren't
Oh
the
yeah.
exact stats, but it's like something just ridiculous.
Yeah, and eventually people are going to get used to it, but apart from those major life events, death, divorce, and getting that dream job in another city that you just can't turn down, it doesn't make a whole lot of sense to move now. I mean, unless, yeah, let's just say you're one of those people in cash and you're going to stay in cash. But I know I just checked my mortgage. It's unbelievable. I don't think I'd even say it on the air, but it's lower than I thought it was.
Yeah. So that's what I'm thinking. Like, if we do go into a recession, I think, most people are relatively protective if they're sitting on one of these like 2 to 4% interest rates. And, they've owned the house for a few years at this
Right.
point. I don't think they're going to get to the point where they're going to be looking at foreclosure, right?
No, no, it doesn't make a whole lot of sense. I mean, we can have a wave of unemployment and that can
Mhm.
sweep through, but it's just not going to be like last time where you have unemployment and some people fall under, then the housing prices go down, and then people use their house as an ATM, and then you see more people in danger. No, I mean, we just have a lot of equity, and many of the indices have already started rising. I want to say by the National Association of Realtors, they have the median home price that they track, and that's already back at peak levels. And then Case Shiller, I'm almost certain that the next value we're going to get to come in is going to show that we're already back. So at least on the single family side, now there's a pretty interesting disconnect going on right now. If you take a look at the Freddie Mac data set, Freddie Mac has an HPI, which is single family, and then they also track multifamily. And you can see that the multifamily prices, perhaps not a big surprise to your audience, is still softening. So
Mhm.
something I like to track because people are using one as a proxy for the other. But if you're in one of those, and I believe it's a little bit over 20 metros that Freddie Mac tracks, and you're in multifamily, definitely just go right straight to the source. If you're not, then I think you do have to use the single family data as a proxy, and beware, because when the trend is set up, the two data sources are very closely correlated. But when
Mhm.
those trends reverse, which of course that's when you need the data the most,
Right.
that's when you really can't rely on that single family data as a proxy.
Mhm. Yeah. Are you, how much more are you expecting them to retract as far as larger multifamily in pricing? And, are people that you're seeing still executing, or is everybody kind of waiting on the sidelines? And,
Yeah, well, all of the above.
mhm.
So some people waiting on the sidelines, and that's certainly having an impact. I don't know how far it'll go. We don't know where the rates are headed. I mean, everybody said that we're practically at peak already.
Mhm.
We don't know. The other thing we have to remember is we talk about the Fed like the Fed is in charge, and the Fed is not in charge. Anybody can remember the taper tantrum knows that at the end, it is the market, and the Fed is just another player in the market. Difference between them and, say, you and I, Mark, is that they get to play with funny money. Okay,
Yeah.
they can create it out of thin air, and they can do as much as they want. But at the end of the day, uh, we really don't know what's going to happen with rates. And perhaps we'll see the rates continue to soften.
Mhm.
I'm sorry, the rates continue to rise, and therefore the prices continue to soften. So
Yeah.
it's difficult to say, and yeah.
I personally think they're probably gonna try to keep rising, right? And unless something
Mhm.
breaks, they're just gonna keep inching us up,
Well,
slowly
that's
but
true.
surely, but
There's one practically mythical soft landing in 1996, the only time that since recent statistics have been kept that the Fed hiked and that we didn't have a recession. So, I mean, there you have it. I mean, it's practically 100%. The Fed starts hiking, and something goes bust. I mean, one way
Mhm.
or the other. I mean, we have the business cycle too. Again, it's not all just the Fed doing what they do, but certainly they're going to push things in one direction, make money tight, and that continuing along with the fact that sooner or later there's going to be malinvestment in the economy. When money gets tight, it just gets exposed so much faster. Likelihood of that recession is
Yeah.
just very, very high in the short term.
Yeah, so when are you predicting a recession? Do you think in the next couple of years?
You know, again, I hate to hedge, but I think that it's only fair to say that we are in uncharted territory. When have we ever printed money like this?
Mhm.
And we are the only country in, since, we've become the world's global reserves currency that can get away with it. So, I mean, I do think that we're kind of going on a sugar buzz right now, but we kind of opted out of that COVID recession, which of course was partially caused by, well, what do you expect when you shut the economy down? Is practically the definition of a recession. I don't know, but I think that it's entirely possible when things do go bust, it will be pretty huge. I mean, the last recession was pushed by many things. There were a lot of risky financial instruments, but it was really like a housing driven recession. That's what everything got back to. Now we have an everything bubble.
Yeah.
So what's going to happen this time? I really don't know. So on the one hand, the timing could be a lot further out than we think. I mean, it already is further out than most people have thought
Mhm.
because of that sugar buzz. But at the same time, when something breaks, what is it going to look like with so many asset classes inflated? It's, yeah,
Yeah.
brave new world.
Right. Have you been following the, like, LNG thing that China did where it's like a 20-year 20 I just kind of briefly skimmed it yesterday. It's like a 26-year contract where they traded treasuries for this 26-year contract. So they're, dumping treasuries, and then the question is like, what's going to happen to the US dollar when this continues?
Do you want to elaborate? Are you talking about liquid natural gas?
Yeah, yeah.
Yeah,
So
okay, good.
China
I actually
has
do follow
traded.
shipping, but I missed that story. I mean, uh, anyway, sorry, I don't want to digress into shipping. Let's take it where you wanted to go.
Yeah, I was just going to say that, they've got all these treasuries, and now they're swapping the treasuries for long-term contracts on LNG. So,
Yeah.
the economists that I've been following are saying that's going to have a huge impact on, what's going to happen with other countries and, with our economy, and it's it's going to be a
Well,
mess
yeah,
is what they're.
recent story, BRICS nations not going to be settling in the dollar, and there are a lot of things that go along with that. I mean, I guess I might as well just say it. I mean, we just call it the elephant in the room. I mean, the seizure of Russian assets. Nobody, I think, is very happy with Russia
Yeah.
right now. But I mean, when you do that, basically you're telling India and their other trading partners that hey, watch out. The moment you do something we don't like, and it was a little different. I mean, we didn't really have the world along with us. This is not like sanctions against Iran, for example.
Mhm.
This was a little bit more divided. I mean, people in the United States may not feel divided, but those countries that are a little closer to Russia and who are strong trading partners of Russia just said, hey, we're not going along with this. And I think that really has hastened the demise. We already talked about the vast inflation in the dollar. And perhaps we're yet to see the tremendous effects in inflation. I mean, we got pretty high, but still, it's nothing like the volume of dollars that have been pumped out. So, I mean, if that all comes back to the U.S. right now because people are no longer settling in dollars, we really have no idea how much inflation might come. I mean, this
Right.
might be you haven't seen nothing yet. And
Right.
think about the 1970s. That was a time in which inflation did have a dual run, and Fed thought they brought it down, and they did to a certain point, and then it just took off right again. So we really don't know what's going to happen. We can't say, well, inflation has been quelled. It's rates
Yeah.
are coming down and everything's going to be good. Rates could shoot back up, or they could continue to shoot up before we even see the respite we expected.
Yeah. Yeah, for sure. And so what do you think about housing prices if that does happen? We have a little bit of a runaway inflation. Is that just going
Yeah.
to push the dream of home ownership out of most Americans' reach?
Well, for a time, it seems it already has, and it may continue
Yeah.
to do so. If you do plot the sticky CPI, so that's less the food and energy in the 1970s during that great inflation, and you plot that versus rent levels, you'll see that the two, it's surprising how close they are. And of course, rent is a major component. I mean, we can talk about how appropriate the way that rents are being measured, which is not appropriate at all. But it's pretty amazing, and not on a year by year basis. So, when you're out there investing and you feel like, man, my expenses went up this year, but my rents didn't. You know, you look at a 2, 3, 4 year period. It's very, very, very close. But as you mentioned earlier, real estate's hyper local, so then you've got to be very careful. So yeah, on average, but how diversified is any one investor's portfolio? Not very much,
Right.
and you have to focus. You have to do that. So people still get soaked, but on average, yeah, I think that it'll be just fine for real estate. I mean, you need hard assets. So look, unless you know when inflation's going to go on a tear, it's just not a great idea, in my opinion, to invest in a big way in gold. So what
Yeah.
have you got left? Then, if you don't feel that you can precisely predict the run of inflation, then you've got to have a hard asset, and real estate, I would say, is the crown jewel.
Yeah. So do you think companies like BlackRock that purchase all these single family homes during the boom cycle, that maybe they hired third party underwriters that were a little bit risky, or maybe underwrote some stuff they shouldn't have, right? They didn't hit their rent rates. They thought maybe they're going to get 2,500 and they're getting like 2,000. And then they've also had a little bit of a retrench in the pricing, right? Where maybe they paid about 20% more than the
Mhm.
current value. Are they just going to hold on to all this stuff and it doesn't matter because they know that, we are on this course of, owning real estate is smart? Or do you think they're going to be in a position where they've got to dump some of this stuff back to the market, maybe create a little more supply?
Well, that certainly make things a little more interesting if they did. I don't think it will, and I think that they will be able to hold on because, as I said, the prices have already recovered, and the rents are there. I mean, we saw a little softening for a while in some places, but what do you expect? I mean, people who buy at the top are always going to be in trouble. So
Mhm.
when we saw the major run up in rents from 2020 to 2022, even we give back some of that. Most of the people who bought, except for the people at tippy top, they've really got, quite a run up in rents already. So I just don't see it happening at this point.
Yeah. No, that makes sense. Awesome. So you do multifamily primarily. Do you go into like self storage or any of these other asset classes that people like, mobile home parks? Or are you strictly
So I do all kinds of
multi?
things, but again, you got to stay in your lane as an active investor. So as an active
Yeah.
investor, I'm focused on multifamily. I did pick a few projects outside that, like a hotel to multifamily conversion. I want to be able
Okay.
to take my investors somewhere else if needed.
Mhm.
And I'd love to do, as you mentioned, build to rent. That's something I'd love to do. I think you really need to have, again, I don't, it's a little bit counterintuitive, but you need to stay in your lane in general, but you want to diversify a little bit within that lane so that you can move where you need to, where you
Mhm.
have to. And for my personal funds, just all over the place. I mean, I've done some early stage company investments, and investing in triple nets, private equity. And I think that as far as being a passive investor, it's what everybody should be doing. There's no reason why you have to be highly concentrated in your personal portfolio. It's a lot easier to vet a deal than it is to go out and sponsor a deal. So as a sponsor, focus, but keep your eyes open. As a passive investor, go as far and wide as you can.
Hmm. Have you thought about repositioning office space into residential, since we do have this kind of glut of underutilized office in a lot of these MSAs?
Well, I think that's great, but it's a little different because I mean, if you've had issues with plumbing in a hotel, for example, and there are ways around that. I mean, people who end up with, a 100 key hotel, and then they get a 100 studio units out of it. That's one way to get around the plumbing problem, but
Hmm.
probably not the best thing to do in your market. So
Yeah.
you can go after places that have a larger size when you're looking at hotels, but can you do that with an office? No, I mean, basically it's one great big floor and you've got some columns there. That plumbing is a huge issue. So yeah, I mean, at a certain price, it makes sense. It's a lot harder to do. I've stayed away from it, but I'm sure there are going to be many people that are going to be successful.
Mhm. I know in my area, there's a lot of grant funding. Usually 20% state, 20% federal on all hard soft costs. And some of these zones that they've dedicated is like they want to get some regentrification and get some life back into them. So I think that's really makes the development that I've seen of these conversion of these office buildings possible. I don't think it would be financially viable otherwise.
Mhm.
Yeah, very cool. So it's 2:30. We got lots of time. I'm blanking on questions. Um, I don't know. Do you have anything anywhere you want to take the conversation? I miss my
Yeah, sure.
co-host. See, he's not here. Usually we go back
Yeah,
and forth. He
exactly.
gives me a
Should carry
second,
for
I
the
think.
other half, but
Yeah.
well, congratulations on the new addition to the family. So yeah, I think we could talk about markets. I really enjoy that topic. And
Okay.
again, you got to look where people are moving.
Hmm.
And there are many ways you can do that. I think everybody looks at U-Haul and that's important, but take a look at other things, right? You've also got United Van Lines and where are people moving? So I mentioned Cincinnati, West Chester, Ohio. Probably never heard of it, but that's one of the suburbs of Cincinnati. So
Hmm.
further evidence that you've got some great growth out there. And I have to avail yourself of all the resources. So, I mean, look, see how rent constrained it is. Look and see where people are moving. How many resources can you get? People do various polls. I see a lot of people doing research on Florida because people are moving so hugely to Florida. You don't have to wait for the census or U-Haul, United Van Lines. You can get some, not up to the minute, but maybe up to the last year statistics generally on that. And I think that's gold. And I think it's very much helps to be a contrarian.
Hmm.
So we've had a very, very long economic cycle. Call it a very anemic recovery. Some people, even like Jeff Snyder, I think maybe on the far end, calling it's like a depression. I mean, look how far we are under trend growth. But guess what? It's been growth. And so people have gotten away with taking their mentor's playbook and running with it. But yesterday's good markets, in many cases, are today's bad markets. A lot in Idaho, like that. Best
Hmm.
markets of like 2022. Many of those are on the list of the markets that you might want to stay away from in 2023. So I think really, when you go out here and you're looking for advice on the internet, make sure, I mean, figure out what the shelf life is, because I think you got to throw out the old playbook and you got to be a contrarian. You got to be willing to go out there, do your own research, and figure out which trends are likely to reverse. And geographically, I mean, it's just a mess out there. The places that people thought were going to be just wonderful have just crashed like nuts.
Why did they think they were going to be wonderful, and like what kind of changed to make it go the other direction? Do you think it like kind of was wonderful and then just everybody piled in and it was like, hey, we can't support, it's wonderful, but we just can't support what's happening, kind of thing.
Well,
And now we're gonna have,
absolutely. And the people who moved into, Southwest markets, Idaho are the two I'm picking on. Yes, you have this great trend, but no trend continues indefinitely. If it did, then everybody would be living in Florida, Las Vegas, and the Texas Triangle by now.
Mhm.
So, relax and realize, what inning am I getting into this?
Yeah.
So if you've already got a lot of real estate in some of these places and you've already seen major appreciation and you're buffeted against maybe a new acquisition out there, then hey, that's fine if you can handle it. But if it's your first acquisition, again, I'm imploring people, go out there and find some place that's early innings. And I
Yeah.
think a lot of places in the Midwest are like that. But again, you got to be careful. Much of the Midwest is continuing to lose population, but find the good spots, find the success stories, try to be the next person to find the first Cincinnati or Indianapolis. Don't just
Mhm.
replicate what worked 5 years ago.
Yeah. Yeah. So when I hear like Texas and Phoenix, Arizona, I feel like it's the ninth inning, and I really don't even want to
Yeah.
get involved in that. I'm with you. I want to find a new spot. So that's
Yeah.
really
Well,
great
let's take
advice.
Florida, for example. I mean, you see a lot of growth throughout Florida. You don't have to invest in Tampa, Orlando, and Miami.
Mhm.
There's more to Florida than that. And the Panhandle continues to lose population in many places. But some of the rural counties are growing in a pretty decent way. So you may be able to go out to a tertiary market and get a decent price and see some pretty solid growth out there. So I mean, again, I think if you want above trend results, you have to be a contrarian. There's no other
Mhm.
way.
Yeah. Have you played around with the short-term rentals at all, even like on a fund scale where you get a whole bunch of them and kind of operate them like you would a larger multifamily, just more properties?
So I haven't, but it's something I'd really like to do. One thing I'm really big on is seller financing. I love creative financing. People say you can't do it. It's nonsense. You can do it with anything. Just
Mhm.
talk to people like thinking Bill Ham and Pace Morby. These are people who do this all day long. So if you can get that seller financing, even on these bigger properties, and sometimes it happens, uh, then that frees you up. Because what prevents people from doing the single family rental? Well, it's that, well, then I can't get that agency loan. And then I'm stuck in this recourse loan that I don't like. And even though things are going pretty good, and I know that I should have better cash flow with short-term rentals, then it ties your hands. But boom, you get that seller financing for sometimes you can get 5, 6, 7 years fixed rate under market, and then you're free.
Mhm.
You can renovate the whole thing. Don't worry about your occupancy. Turn it into short-term rentals. There's other things like Pad Mapper. You can get people coming in to rent a room or a unit in this case, and just go wild with creativity. See what makes sense.
Yeah, part of me feels like, the people that are doing it, great for them. They're making great money, but I almost feel like that's like the ninth inning too,
Yeah,
where I don't want to get myself wrapped up when now we've got funds entering the space and they're purchasing tons and tons of single families and turning them into these short-term rentals, that maybe some of these markets are going to become overly saturated with this short-term product, and
right.
it doesn't really underwrite to a long-term
Mhm.
lease, and then you're kind of stuck with it. So that's been my hesitation personally for jumping into the short-term
Yeah,
space.
100%. I love everything you're saying about not jumping in the late innings and then making sure that it does underwrite to a short-term lease. Because I see people out there doing deals because, well, hey, if we turn it into a short-term rental, this and everything works out, then it'll be perfect. But
Mhm.
watch out. And another thing to watch out with that too is that if you're doing a redevelopment, I mean, I see other mistakes, like people are not going and talking to the city. And I think the reason for that is that I guess it's frightening to talk to people for many of us. I don't understand this. I mean, I got my own show, Mark. I love talking to people,
Mhm.
but just call up your locality and see, how do they feel about a major redevelopment? I mean, I hate to say it and pick on rookie mistakes, but if I can save one person today, I'll be really happy.
Right. Yeah. Yeah, definitely talking to I think part of the problem with the city or the municipality is that you're afraid they're gonna make you do more than you anticipated. You
Right.
call them to ask them a question, and now you're on their radar, and they're like, "Oh, what about this, and this?" And you're like, "Oh,
Yeah.
crap."
But the flip side of it is that, look, you may get a warm reception, and if you don't, I would say don't do the project. So if they say like,
Mhm.
yeah, that's exactly what we want. We need more short term around here because this is a tourist area. People aren't building hotels. Hey, if that's the reception you get, go and do the project. But
Mhm.
if it's cold or lukewarm, go someplace else. Not having the city on your side is going to make your life and your returns and your investor relations a lot harder than you want it to be.
Yeah. Well, they've got to answer the constituents too, right? So
Hmm.
I think that they probably might even tell you, "Hey, yeah, we like it. We like the idea. You're going to bring revenue. You're going to bring, improve properties, more taxes, etc." But then everybody in the neighborhood, they're like, but I don't want the house next to mine to be a short-term rental.
Right.
And I get that. I visited my friend in Saratoga last weekend, and they had lived next to the same gentleman. He raised his family there, and he had gotten older, and he sold the house. And of course, a short-term rental person bought it, and they're fixing it all up. And he's like, "Yeah, that's one less neighbor that I'm going to have that I can talk to. When I'm having my coffee on the porch, they're not going to really have an
Mhm.
eye on my property like he did." So from their perspective, they don't like it. And then the other thing that's happened in their market, Saratoga Springs up in New York, is that from the time they purchased until today, the housing prices have like quadrupled. And he's been there for about a decade, and so it's just an insane amount of property value growth. And a lot of this has been driven by it's a destination town. People go there for the races, and everything has just been converted into a rental.
It's never easy to deal with that. You've got NIMBYs everywhere, and maybe I just don't have enough time to follow what my neighbors are doing, or maybe because I have a background in development that I don't care as much. But I mean, it introduces a new buyer, and I understand if you got a whole lot of cars there, but usually if you got a decent driveway, it should be
Mhm.
more efficient. So generally, I think it's good. I mean, the short-term rentals I've stayed at, they're very nicely maintained.
Mhm.
And there is a huge incentive, of course, to the owner to maintain them well because it's an investment property. So I don't know. I think people should just get over it.
Yeah, well, I'm thinking of it more from the municipality standpoint, in that they might say, okay, we're going to do it. They allow it. People get in. The prices get driven up. Now everybody that's local that has a normal job is like, hey, we used to be able to live here and afford to buy a house, and now we can't. And so now there's some pressure on the government, and now they
Right.
start restricting it, and then you've got to deal with that. Now it's like, okay, maybe they're even clawing some of those things back that they've already you know so I think there is the possibility for that. I had a friend that purchased one in an area where there was really no restrictions. He was free to do it. And it was a nicer house, and it's a very small village. And the neighbor complained so much that he actually was not allowed to operate there anymore after he purchased it. And it was one of these ones where it really didn't underwrite as a term lease at all. It was a
Yeah.
$400,000 house. And so he was forced to sell it. And when he was forced to sell it, it wasn't the most advantageous time for him to sell it either. So I don't think he really lost any money, but I could have seen that being a bad situation potentially, right? And so if that kind of thing can happen within a municipality, I think that's kind of the scary side of working with the city, because one day they're like, "Oh yeah, great, you could do it," and the next day is they're like, actually, no, we don't want you to do it anymore."
Yeah, so it may be a good thing to wait for the next leg of the short-term rental story. It's something that I hadn't gotten into before it had gotten so very well developed, and so yeah, I just never did. But again, yeah, if you can do it as a bonus, as the icing on the cake, that's the thing to do. So one of these days, seller financing apartments, definitely going to do that.
Hmm. Yeah, for sure. And then how are you structuring the seller financing on the apartments typically? What would be like your ideal scenario? Because I mean, they're obviously going to want you to have some skin in the game anyway. But if it's a
Right.
value add, then you've got to bring more skin to the game. So are you thinking they'll do 100% financing, knowing that you're going to do the value add, or are you expecting to have some kind of equity component going into
Yeah,
it?
definitely need some equity component, but the value add is something very important to point out. Sellers are always worried, they want the largest down payment possible. But if you point out that, hey, I'm going to put in at least $100,000 into this in the first year, they understand just as well as a bank does, maybe even better, that the quality of the collateral is huge. So look,
Mhm.
if in 1 year you get the thing back and it has some significant renovations, hey, that's a major win. So yeah, you may have to put in the same amount of down payment that you would with a bank, but I've seen some majorly below market rates. Like, for example, I remember in 2020, I bought something at 4% when, rates were in many cases larger than that. It was less than $1 million and it was non-recourse. So there's a lot of good things about that deal. I've seen somebody negotiate 3.5%, and that was in late 2021. And so it was, before things got crazy. But again, 3.5%, that was really good even back then. And that was for 7 years, 7 years fixed. Oh,
Wow.
and did I mention none of these deals have a prepayment penalty? Actually, the first one did,
Yeah.
but it's not that bad. You've got some reno that you're going to need to do anyway, and as long as it's something simple like a 3-2-1 step down, it's okay. A lot of the sellers, they're not very sophisticated, and
Mhm.
they don't. I mean, I hate to say it, they're just not protecting their own interests. So
Yeah.
those terms can be pretty broad. And here's another good one. Let's say that a deal doesn't work at the price with interest. So just don't never say zero interest. That's
Mhm.
dirty, dirty word. But just ask for principal only payments. I mean,
Mhm.
that's if you can say that with a straight face, boom, you may find yourself in zero interest land. So what I would say with seller financing is just ask for what you want. And
So you
if
would put the sorry, you put the financing on the end then. So you say, "Hey, I'll give you principal only, but then when I cash you out, you're going to get your interest."
oh
Or do you
well,
s- or d- or do you say,
even
"Hey, it's
that
principal
deferring the
only."
payment, that's good, but you never know what'll work with some people. Like if you say, look,
Okay.
that price, only works if I can just make principal only payments.
Okay.
So it sounds a lot better. It goes
Right.
down
Then
better,
yeah.
but it's the same idea that I'm just going to pay principal on this, and yes, when it balloons, you're going to get the remainder of the principal. But hey, even if you can defer it, that's good too. So what I would say with seller financing is that whatever you can say with a straight face, do it. Ask, find
Mhm.
out, because you don't know how badly somebody wants to sell their stuff, and particularly if you're the third or fourth or fifth or sixth person who's kicked the tires, they get the idea that, look, this is not going to get conventional financing. Nobody wants recourse on this property in the hood. The only way I'm going to sell it, and sometimes it takes some time to get it through the head of the broker too, that okay, look, you really want to sell this thing, yes, it's time to consider seller financing. So particularly if you're not the first or second to look at it, then just ask for the terms that make the deal really sing for you, and then let them pare it back a little bit. But don't be shy. You never
Mhm.
know just how much you can get.
Yeah. So I'm remembering now you focus on C class, so that's great. So maybe talk a little bit about, what does that seller typically look like? Are they older, nearing retirement? They just have like one building, or do they tend to be, investors that have a few buildings? And then, yeah, maybe answer that one first, and then I'll follow it up.
Yeah, sure. Often older, often nearing retirement, generally having one building. And I think that really helps because, again, there's somebody who probably hasn't optimized it, but that doesn't mean you're coming in and ripping somebody off. They
Mhm.
can't expect to be paid for work they haven't done. So if
Yeah.
there is optimization to be done, that leaves a little meat on the bone. And then at that point, you can still give them a fair price and make your money. But yes, single building owners are some of the best sellers that you can possibly want to find. And because they never did go whole hog into it, it may be very much that much easier to then say, hey, you know that you get the right terms, because again, they just want to get out.
Mhm. So how do you find that, they're older, they've owned it for, a decade or two. They probably have way under rents, right? They're probably 20, 30% off the true market value. Are they typically self-managing it, or they got a couple people like handymen that work for them, or do they outsource that?
Yeah, I mean, that can be the only way to go in some cases. So first of all, are they 20 to 30% off the price? Maybe not.
Mhm.
Sometimes yes, but even if you buy at a fair price, if you get the right terms, it can make sense. Having somebody self-manage, I go for tertiary market. So sometimes that's the only way that it really makes sense. have that handyman on site. And I mean, you don't have to continue with them. You can go ahead, get the third party management, but you may keep that person on just to do the handyman work, because there's nothing like having the value of somebody that you can talk to at any hour and have things fixed, like potentially this evening,
Hmm.
and at the best price. Because a lot of those people, they may be on Social Security, they may have had some investments, but they really just need a little supplemental income. It can be a real win-win situation to put a few extra dollars in their pocket and make sure the tenants are taken care of.
Okay. So that's actually the owner sometimes, not necessarily like the staff of the owner.
Well, yeah, usually it's a tenant. So if you
Oh, a
got that
tenant.
one
Okay.
tenant, and in
Gotcha.
this case, it's almost always, it seems, an older gentleman and just somebody who just wants to keep busy and just would love a little extra cash. And those people are perfect. Like I said, total win-win. And
So,
usually, well, it's also how they get along with the tenants. But again, usually they were handpicked by the last owner, and you can tell that it's like they're like the mayor of the place. They know
yeah.
everybody, they know what everybody needs, and they enjoy taking care of everybody. It kind of raises their profile. So, yeah,
Hmm.
those are the sorts of people. But again, usually that's in place. If it's not in
Yeah.
place, and I'm there and I'm thinking like, well, oh, walk and do my walkthrough. Which tenant would I want to,
Hmm.
elevate? No, no. But if it's there, take it.
Yeah. Do you have that person also collect rent, or are you still relying on a third party to do your rent collections, your evictions? And what do
I
your
like third
evictions look like?
party because I mean it does make your life easier. You know it's done
Mm.
professionally, but in some rural places that may be the only thing to do. I mean, I was looking at a place out in West Virginia. If we'd gone through it, we didn't go through it for various reasons, but we would have kept a person of that exact description on, somebody who just, hey, doing the renovations, collecting the rents. I mean, hey, if it's working, and that can be extra cash flow because again, whatever you're paying them, it depends on the size of the complex, but 30 or 40 units, if you're giving them free rent, what is that compared to your total? I mean, like at best 4%, and
Hmm.
they're probably not charging a lease fee. So it's I say it's more
It's a
like
win-win.
sorry, 4% if you're around 25 units. At 40 units, it's more like 2.5%. So I mean, really, if you have just the right size complex where one person can handle it, and they are handling it, again, like you mentioned earlier, you got to make sure you're underwriting to third party management, but you can
Hmm.
get away without it, and it's working well. Good,
Yeah. It's more profit.
yeah.
What do your evictions look like on the Class C? Are you in areas where you're still relatively protected? People are pretty employable and they're paying their bills, or do you have a certain percentage where you're constantly turning over due to non-payment?
Well, there's going to be some from time to time. It depends on the quality of the property. I mean, after a total reposition in Orlando, it's occasional. It's
Hmm.
just situational. From time to time,
Hmm.
you're going to find people that are down on their luck, and it's sad. You want to work with them if you can, but you can't always work with people. And then, if you can't afford to do a total reposition, if the market doesn't support it, then understand that you're going to continue to have some issues.
Hmm.
If I could just harp a little bit on underwriting, that's another thing that I see. Some people, you don't see uh, any legal costs. I mean, seriously, even for Class B, I mean, you're going to have evictions.
Yeah.
Chase that down. Is that under some other rubric? Is that or But you better know what those legal costs are, because if you don't, yeah, you're really getting yourself potentially into a major
Yeah.
situation.
So would you say you're going like C plus and then you're getting it up to like B plus, or what's your model for
I
your
would say I'm not
evaluating?
afraid of a C minus, but again, it
Okay.
matters the crew, it matters the area. Does it make sense to make it a C plus? And then I've done a lot of smaller things, so there's no talk of making a B because we don't have amenities. But it could
Hmm.
be the nicest C plus in the area. It could look like a B. It could
Hmm.
even look like a B plus on the inside. But you're not going to have the amenities, so you can't quite compete. You got to consider that you're going to keep your rent $100 below the people who do have some nice amenities at least. But the point is that, yeah, you just have to really see what does the market support, and if it does, then yeah, go ahead, make it nice, enjoy a better tenant base. But again, remember, you're never going to get B rents without some amenities.
Yeah. Yeah. So what are you doing as far as data collection to support your thesis that you'll be able to add that value?
So first thing I do is I do more extensive rent comps than I see anybody else doing. I like to get the pictures side by side. I go into a spreadsheet and I've got the square footage, I've got the amenities listed out. You can see that from the pictures too. But the idea is that I really want to see it all side by side and I want good comps, not to sort of throw out the comps that you got from the broker. There
Mhm.
might be 2 out of 5 that are slightly better than your property. Okay, so keep those as the slightly better comps, but go find something that's at or below your property. Make sure that, hey, if somebody down the street was something a little less nice than what you currently have, or a little less nice than what you're aiming for, is getting the rents you think you can get, then I would go for it. But again, yeah, it all comes down to the rent comps, and I say just literally, you got to lay it out on each page. And of course, this is what the broker's never going to do, is tell you which one is superior. You really got to go through everything. Like, is the
Mhm.
kitchen nicer, right? Whatever you want to do, if you want to have a 5-star system or just something more qualitative and say, the kitchen here is superior, but the bathroom's inferior. And so I'm going to say, on the whole, that this is a slightly superior comp. But yeah,
Mhm.
you got to get really quantitative with it. And I feel it's almost counterintuitive. I think in the single family space, of course, because you do have more comps, you see the realtors will go through and they'll give you, they'll go through just like an appraiser would and tell you, hey, we're going to subtract this much for, this amenity. They've got a swimming pool, et cetera, et cetera. But, here, I think, unfortunately, and part of it's because we don't have as many comps, but we're not doing what we can with the ones we do have. People are just relying on lousy comps, and you can't do that at the top of the market.
Yeah.
When we had a strong trend, you could get away with a little slop, and I don't think you can do that now. So I would say really focus on those comps. Make sure that like you're accounting for everything. I mean, if you have the smallest units in the area, it doesn't really matter how nice there are. Do you see somebody else with small units that's getting the rents? And the same thing for everything else. I mean, if every comp that's getting what you think you can get has a swimming pool, you better make sure that you've deducted enough. Again, I always like to have comps that are less desirable than the property, but you're going to
Right.
have to find those yourself.
Mhm. And I had a follow up. What was I going to say? Oh, are you having to like call these other places and verify that there's no concessions that you can't see that they're giving to rent, like maybe free first month or free whatever, or discounted something that you're not seeing in these comps? Do you go that far, or
Yeah, that's
is that just
outstanding.
kind
I
of
think that's absolutely right. I mean, think about it. Peter Lynch was famous for saying that people put more research into the purchase of an appliance than a stock purchase, which in most cases can be a lot more than an appliance. One up on
yeah,
Wall Street, if you want to go check him out. Great guy, Peter Lynch. And he's 100% right. And I think, unfortunately, and again, harping on these rookie mistakes, but people are not doing that.
yeah,
Call. For crying
mhm,
out loud, how much time did you spend talking to the broker? How much time did you spend in that underwriting spreadsheet? And then ask yourself, how much time did I spend on the horn actually talking to the property manager and saying, oh, wow, you don't have any 1 beds this month. Oh, well, hey, by the way, how much is your 2 bed? Yeah,
yeah,
exactly. Make sure, because here's the other thing that I see, even when you do go out and do the detailed research on the internet, you have to ask the questions like, wow, that's actually low. I said this to a property manager the other day. It's actually kind of low. Are those for your renovated rooms? Just like the pictures there in in apartments.com are just gorgeous. Is that, you know, verify that,
mhm,
because I saw one case of something in Michigan, and it looked like there was this property that had not been renovated that was getting these awesome rents. But if you go to 5 or 6 websites, you'll find out that the first website that came up had some old pictures. So yeah, you can never do too much research. Go to 5 or 6. When you think you found something that's very closely comparable, go to 5 or 6 websites and call.
mhm. Yeah, that's great advice. Very cool. So, what are you focused on now moving forward? Are you're saving up your dry powder for some great opportunities, or are you still finding stuff that pencils?
Well, a little both. I guess I always hedge, but Hey, I'm always looking for deals. And I'll tell you, one of the reasons why I did talk about the things I'm seeing is because I do have a lot of newer people that are sending me deals. I love to mentor people. I just
Mhm.
love it. So, hey, if you're out there, you're listening to this and you got some deals, if you think that I'm the guy to help you bring it across the finish line, whether you like my personal style or whether you like my criteria, you think we can work together, send it out my way, and I'm willing to work with you. And I don't mean this in any way to be hard on or to harp on newer people, but just trying to save you from some mistakes and give you some ideas of what I'm probably going to say when you bring the deal to me anyway.
Mhm.
So make sure that you kind of dot those I's and cross the T's. I mean, I wouldn't discourage you coming and sending things my way, but the idea is that let's just make sure that it really makes sense because again, hey, look, if I've done a half dozen deals and this is your first, it's going to mean a lot more to you than to me. And so making sure that that first deal is the right deal. A bad deal is going to put you back a lot further than a good deal will put you forward. So make sure that
Mhm.
first deal is the right one.
Oh man, I love that. We're at the top of the hour, so it's a great place to close it out. But yeah, I'm a huge proponent of also helping young people by mentoring them and getting them through on the right foot because I've seen so many people take the wrong step forward to begin with, and it completely gives them a bad taste. They run away, they never come back to real estate. Where if they would have just done a little more due diligence on the front end, they could have made a really great investment and then advanced their career from there. If you want to give the audience a way to reach out to you, I'll drop it in the show notes as well so they can, but you can feel free to give a website or however you'd like them to get a hold of you.
Yeah, I'm pretty big on LinkedIn, so that'll work. And I'm also going to drop my link tree. And so if you want to come find out more about the data
Nice.
scientist of real estate, you want to see just how entertaining the real estate data can be. So you'll head out to my YouTube channel. You can find it there. And also I've got a weekly Zoom call. So if you like to network,
Oh,
you'll
nice.
find that in link tree. So yeah, come out
Heck
and
yeah.
find us every Wednesday at noon Eastern. And we'd love to have you. You'll get to meet some people of all levels. So
Nice.
wherever you are in real estate, you'll find somebody that you can hook up with. CRE Network, where deals are made.
Awesome. Well, thank you so much, George. It was great having you on the show. I will definitely be there next Wednesday to talk data and talk analytics. So
Yeah,
this is
I
awesome. Thank you so
appreciate the
much.
opportunity. Thank you so much for having me, Mark.
Yeah. We will see you soon.
All right, thank you.
Yep.